in the short term, meaning over any period, days, weeks, months, maybe even quarters, markets prices are a function of supply and demand. Theory, fundamental valuations, all of that only matter in the long term, right? That's the weighing machine. And the short term is how many people are voting to buy and how many people are voting to sell. And the reality is that's what flows are. Flows are how many buyers are there, how many sellers are there. So if you're looking to predict market outcomes, if you're looking to say, I want to be invested or I don't want to be invested or for X period of time, and it's anything less, believe it or not, than 10 years, right? There's actually been a bunch of research that says fundamental valuation metrics are not only non-correlated to market outcomes, but they are often inversely, if anything, tied to market outcomes in shorter timeframes. Anything less than 10 years, they're essentially irrelevant. And that's crazy because everything you hear on CNBC or anything you read in the Wall Street Journal tends to be about fundamentals. But in terms of actually investing on periods that are shorter than a decade, they're essentially irrelevant based on research.
Welcome to the Rose Show podcast. Thank you so much for joining us today. I am here with Cem Karsan. He is the expert on volatility, founder, CIO, and managing principal of Kai Volatility Advisors. He's also head of research and risk management. We're in a changing environment and we need to invest different. So how you doing today, Cem?
Good to be here. Thanks for having me. Interesting times.
Absolutely interesting time. Thank you so much for being here. A true honor. You are the maestro on volatility, and we're definitely going to be talking about volatility as well as these diverse, different investment strategies that you talk about quite often. So we are in a different regime. The past 40 years, we're in different times here. We're higher for longer. Looks like a secularly inflationary period up ahead. And the cost of money is higher. Corporate profitabilities are impacted, margins are compressed, and there is an importance of real returns due to inflation being entrenched. And we just saw recently with the recent report that core inflation is still rising and it's still in the high fours and it looks pretty sticky. So we need to, there are opportunities though, and there are different ways. And when rates go up, doesn't bode too well for equities. Risk premia increases, liquidity decreases, and volatility increases. So I think we need to begin with that. Volatility. No one better to ask than you, Cem. Tell us, what is volatility to you? A lot of misinformation out there and misunderstandings. Tell us about that and the volatility markets as well as its market structure dynamics.
Yeah, so to lead off, and I've kind of, this I think blows some people's minds when I put it in this context, but this is kind of the world I've been sleeping and breathing for 25 years. And so I have a little bit different perspective on volatility. When most people think about volatility, think about the VIX, right? They think about just like any other asset. You could be long volatility or you could be short volatility. And the reality is that options are the underlying vehicles for volatility. And options represent a different point on the distribution of outcomes for any asset, right? And so whereas options are known as derivatives, my view actually has become that, if I gave you two stocks that were identical in valuation, that were, their prices had no name on them, same industry, you would probably from the outside say those look like the same stock. But underneath on the options chain, one might have an incredibly fat left fat tail, right distribution. The other one might have a right fat tail, left distribution. The timing on the volatility, as expected by the market might be very different in terms of short-term versus long-term. And underneath, by looking at that option chain, you'd really understand the personalities and the realities more specifically of each asset. All the asset prices are the expected value of that distribution. So my view actually is that asset prices are very, very simple. And they're ultimately just, in a way, a derivative of the actual underlying, which is this distribution, this true personality of the market, and which is displayed by the probability distributions of volatility in the options. So when we talk about volatility, we really see it as the whole market what's actually happening under the hood in a very detailed fashion. And so I think that's such a critical departure from how everybody thinks about volatility. People think of volatility as this tangential derivative to the market. It's kind of this weird thing going on over here that seems to be affecting this thing we watch all the time, which are stocks and bonds and commodities. That cannot be further from the truth from my perspective. If anything, the other ones are just a summary. And we've been moving secularly, and again, I've been doing this for 25 years, towards more and more volume, and not just more volume, but increasingly an acceleration in volume into options and volatility as this underlying asset, because it is a superior way to express the dimensionality, the different parts of the distribution, which you cannot do with a stock or a bond or a commodity. And that reality gives me the opinion that this is essentially almost like a superior technology. And we are eventually, it's inevitable that we move to the superior kind of way of expressing the dimensionality of markets. And that's what we've seen now, again, secularly for 25 years. It's why when you look at notional volumes of the market, you actually see more now in options than you do notionally in stocks often, and why the effects from the option market have become more fodder for podcasts, and why you now see me everywhere, right? It's the reality is this is kind of the underlying and where the world is moving to, because it is a superior product. And we're really hitting a tipping point. There's more access via different platforms. There's more education. There's more, when I started the business, there were quarterly options for just indexes. Now you have for every product, you have a daily expiration. Every 5 strikes has a strike. You've gone from 250 multipliers to 100 to 50 to 1 to 1/100th, right? We are down to nanos. There's just so much more products, so much more education, and much like a technology, we're starting to hit a tipping point in terms of adoption and liquidity. So big dive in there at the beginning, but yeah, it's a loaded question with me, right? Volatility is not a tangential corner of the market. It is the market. And I think understanding it is critical to anybody who is playing.
Agree completely. You are so passionate, and I love that. This is exciting. I think of it as like the short term, the market is being led internally by these flows. And even if people don't trade options, it's very important they at least understand and they're able to read this type of flow and at least know what's going on with this OPEX and, on the options expiration every month. And, it's just, there's just so much there. So let's start with the flows. Let's go under the hood. And, there's so many narratives as to what's going on with the market right now. People are like, oh, oil was overlooked, maybe the commodities should be running, and all these different stories. But actually, it's something else that's leading this rotation. And I believe you touched upon that it's actually the S&P is pinned right now. And the volatility, I think the IV is pinned. Could you tell us about that phenomenon and what's going on and why it's causing this forced rotation?
Yeah, let's back up a second. I definitely want to dive into the specifics around OPEX and those flows. But before we hopped on, I was actually talking about fundamentals versus flows. And I think it's important to set the stage here,
Let's
right?
do that.
At the end of the day, Benjamin Graham said, right, that in the short term, the markets are a voting machine. In the long term, it's a weighing machine. What did he mean by that? He meant in the short term, meaning over any period, days, weeks, months, maybe even quarters, markets prices are a function of supply and demand.
Mm-hmm.
Theory, fundamental valuations, all of that only matter in the long term, right? That's the weighing machine. And the short term is how many people are voting to buy and how many people are voting to sell. And the reality is that's what flows are. Flows are how many buyers are there, how many sellers are there. So if you're looking to predict market outcomes, if you're looking to say, I want to be invested or I don't want to be invested or for X period of time, and it's anything less, believe it or not, than 10 years, right? There's actually been a bunch of research that says fundamental valuation metrics are not only non-correlated to market outcomes, but they are often inversely, if anything, tied to market outcomes in shorter timeframes. Anything less than 10 years, they're essentially irrelevant. And that's crazy because everything you hear on CNBC or anything you read in the Wall Street Journal tends to be about fundamentals. But in terms of actually investing on periods that are shorter than a decade, they're essentially irrelevant based on research. The way these things come back in a line in terms of the weighing machine, essentially, is when there is a risky, illiquid period, when fundamentals matter, when the put on the business determines whether a company can stay in business or not, right? That's the point at which fundamentals tend to converge. I've given the analogy of it's like being on an airplane. When you're on an airplane, all that matters is those engines. Are those engines firing? That's going to determine your trajectory. And most times, 99.9% of the time you're on that plane, all that matters in terms of your direction is, are those engines firing and how much gas is there in the tank? That's liquidity. That's the voting machine at work. That's the supply and demand that's creating the trajectory. How far you are off the ground is essentially valuation, right? The valuation doesn't matter in the majority of instances. But when those engines stop firing, right? When that liquidity turns off, that's when how far you are off the ground is all that matters, right? In terms of your outcomes. And so ultimately, valuations are a put on businesses, on a put on assets. That's when fundamentals essentially matter. So we use valuations and fundamentals as a risk management tool. We believe that's how it's relevant. And eventually, over a decade or longer timeframes, you get a liquidity event and things do come back into line. But in the short term, it is not predictive. So with that, in the background, I think it's important to kind of dive into now the flows, because the flows are all that really matter in any short-term predictive time frame. And so how do these flows matter as they relate to volatility? There's all kinds of different flows, right? You have trend following, you have vol targeting, you have risk parity. I could go on to all the quantitative strategies. You have fundamental demand. You have from buybacks, right? For stocks. You have all of these different supply and demand factors. But a bigger and bigger one, as options have become a bigger part of the market, have been coming directly from the options market. So understanding those flows, by our calculations, depending on how big the positioning is, how little or big liquidity is in the market during different time frames, and where you are in option cycles and how relevant the positioning is, it can be anywhere from 10 to 50% on the daily incremental flows that affect the market. So massive part of the equation that if you're not accounting for, you're going to have a very, very difficult time in making a realistic prediction of what's likely. But under that context, volatility products are particularly relevant during as you get into options expirations, because you're beginning to approach that positioning that has more delta, more gamma, more potential vega effects as you approach them. These things get magnified, and those positions that are in those expirations tend to be bigger, tend to be tied to structured products and big other kind of flows that matter. So OPEX is a critical thing to understand because it creates this chunkiness to positioning tied to those timeframes. This is particularly true in quarterly expirations, right? And end of the year expirations, where there's a significant greater open interest and positioning in the market. So how do these things matter? We'll start with the most basic kind of principle. When a customer or somebody comes to buy an option, whether it's a fund or an individual or any entity or government, a sovereign fund, when they come to buy an option, somebody needs to provide that liquidity and take the other side of that trade. That's primarily what we call dealers. It's either a market maker or a bank or some fund that warehouses risk. A dealer is defined as somebody who's warehousing risk, managing that risk, and extracting an edge by providing liquidity to the marketplace. These entities are not looking, generally speaking, at baseline to take a directional risk. They are taking the other side of a trade, right, and hedging out as much of that risk as possible, much like an insurance company would. The insurance company doesn't want to take the other side of your insurance trade. They're doing it because they're pricing in an edge to doing it, and they offset that risk with the reinsurance by hedging it in different ways and balancing their portfolio to diminish their exposure while still extracting the edge that they've collected by insuring, writing you this insurance. This is exactly, in basic terms, what happens in market structure. You have these dealers who are essentially providing these forms of insurance and offsetting their risk in multiple different ways. A big way, because there's not enough liquidity, everybody's kind of in the same general positions. there's not enough liquidity to broadly just do this in the options market. You have to actually hedge these options trades with where there's more liquidity, which is in stocks and bonds and the underlying assets themselves. Often, not exclusively, but often that's a big part of the equation. As an example, if somebody comes and buys, or there's a huge order for buying September puts, a 20 delta put out of the money, for example, a dealer who would sell that order would have to go hedge that by selling stock, because it is a bearish exposure that this person is expressing. And the delta would change of that stock as the market move. That's gamma, right? And change as vol goes up or down. It would also change. That's what we call a Vanna, right? Which is a thing that you don't hear talked about as much. It'll also change in time, because the probability of something happening diminishes over time if it's out of the money, right? Et cetera. So these effects and the changes based on this structural positioning, the effects that dealers will have to create in terms of supply and demand into that voting machine, are the critical flows that people need to understand. And understanding that positioning in the market structure and the parts of the distribution, and understanding the knock-on effects of these Vanna, Charm, gamma effects, delta effects, are critical to the market structure. So hopefully that gives you a broad overview. Generally speaking, the world is long. What means that, if you eat, sleep, and breathe, you have a job, you own a home, you're long economic growth in stocks and bonds, et cetera. The reality is that leads to a market structure where people, as a hedge, broadly buy puts on the broad market and sell calls to hedge their portfolio, to reduce their risk, et cetera. That broad market structure, which is the whole market essentially, right? Everybody hedging in the options market, creates what's called skew in the market. There's a greater demand for downside options than upside options. There is a higher pricing to downside options than upside options. And this simple reality creates structured exposure in the market, in the options market, which tends to be short as opposed to the rest of the market being long. And dealers therefore have to be short underlying and other things to hedge it. It changes based on expirations, based on open interest and the different potential outcomes. But at the end of the day, this exposure needs to be bought back as options expire, as they go out of the money. These effects, as you approach expiration, accelerate. It can be significant. Like I said, sometimes 50% of the incremental flows in the market, a huge, enormous amount that people have to be aware of, that really change the distribution itself of the outcomes. And really affect what's happening in markets under the hood. So hopefully it gives you like a 30,000 foot view. As we approach right now, August expiration, which is actually this week, for example, this is a major effect. There's a reason we keep seeing the market kind of come down from bigger liquidity structural effects to then being bought back and almost being like this beach ball underwater effect. That's the constant buyback of the decay of options. If vol isn't big enough, if there's not enough of a volatile move, if implied volatility itself can't accelerate, then this buyback of stock happens regardless of the market move, and provides generally a support underneath the market in these periods. That said, as you move out of these periods where those flows are big, as we get past expiration, you tend to open up periods where those flows diminish dramatically. And they can diminish all of a sudden right after an expiration. That's part of why we often see big moves start at the beginning of an option cycle. It can often be kind of much like we saw in Feb to March of 2020. Many people talk about it. Everybody focuses on the fundamental COVID reality of what drove that. But that decline didn't start till the day after exactly a February expiration, and ended exactly on the day after March expiration. Wow. It's not a coincidence, right? That was an exactly 1 month options expiration cycle, the full decline top to bottom, almost exactly to the day. That's the power of flows, and that's the importance of understanding those flows in the context of the fundamental world we live in.
Fascinating, Cem. Wow, I have a million questions. Let's start with the Vanna and Chart flows and the effects during this OPEX period. There is a significance right before, I think the week before OPEX, you see a change, the Vanna and Charm. First, please tell us what they are. We know it's delta decay, change in delta. Explain those two in relation to gamma, which is much different. And then tell us what you see, what their effects are in the market dynamics leading up to OPEX the week before. And then like this week is OPEX.
Yeah, so most people start on their options journey looking at delta and gamma. Why delta is like this simple idea of it's two-dimensional. So people are used to thinking about, markets go up, that, based on your delta, it's like a beta, right? That you have. Gamma is the next step, which people can begin to understand because it's just it's still dealing with two dimensions, but with a bit of a, curvature and acceleration. It's a momentum reality, right? It's the first derivative of delta. What becomes more difficult to people is thinking about things in three dimensions or multiple dimensions. And the reality is Vanna and Charm are the contrary effects to gamma. Gamma is the change in delta, right? As you approach or move away from of an option strike. As you get to strike, gamma's at its highest. You can go from something being a 1 delta, right? As you move all the way to a 50 delta, 50% probability of it being in the money, and hedging that 50% demands a lot more delta, right? That thing, I think that gamma itself, people can broadly understand. But what people have a harder time understanding is that as time passes, right, those deltas themselves also change. If something has a 30% delta right now of being in the money, and I have 10 days, but it's 2% out of the money, guess what? If I get to 1 day and it's still 2% of the money, the probability has dropped dramatically. It might only be 1%, right? That is the change in time of delta. And that's what we call charm. Charm itself is very powerful as you start to approach expiration. As you might imagine, these things really start to fall off quickly. The cousin of charm is what we call Vanna. Vanna is a function of implied vol. There's a natural upward sloping of the volatility, implied volatility surface as you go out further in time, much like the yield curve historically, although right now the yield curve is inverted. You see a liquidity time premium to further out implied volatility historically. That means as the market, as things get to expiration, the implied volatility itself decreases. And because of also the structural support that we see during these periods, we tend to see volatility compression in these periods as well. As implied volatility comes down, those deltas also come down. So there's a risk of a very high volatile situation, as you might expect, something 2% of the money, maybe a very high probability, maybe 40% probability if we're 10 days out, like I said, and there's incredible volatility. But if implied volatility comes down, if the expectations of vol drop to, hey, the market's pinned, we're not going anywhere, something 2% of the money might be a very low probability. And that as implied volatility comes down, the pricing of options, the expectations of volatility come down, deltas themselves decrease for out of the money options. That is what Vanna is. Vanna and Charm are the changes in delta of the people, of the dealers warehousing the risk. And those are the factors that drive flows based on time, based on changes in implied volatility. And actually, the majority of circumstances, particularly for the indexes, right, are the most important factors and the things that you can really model to understand outcomes for the market based on time and price.
Wow. Well said. Thank you so much for that. Now, I know they're not as convex, but they're also, and there's a skew in the equity indexes. The downside IV is much greater than the upside IV. So tell us about this phenomenon. I think it's important for people to understand that the banks are short puts and long calls, and they have to buy back those stock as like a hedge as time passes and this IV comes down. And as things calm down, there's like a steady buyback. Could you explain that phenomenon and actually why? What's that whole process about? And what do we see on the surface? That's what's going on under the hood. But what do we see on the surface overall as this phenomenon takes place?
Yeah, I mean, I'll try not to go too far down the rabbit hole because the rabbit hole can get pretty deep. But the important part here is, as I mentioned before, the world is long. People are hedging their portfolios by buying puts and selling calls, right? And there's all kinds of structured products. There's all kinds of ETFs out there, right, that are providing this type of coverage, which there's significant demand for, obviously. Those products lead to, as I mentioned before, a short delta exposure by the people who are warehousing it, the dealers. If you're selling a put, you're selling stock. If you're buying calls, you're selling stock as well. And generally what the dealers are being put into. They're getting a premium for it. The calls are at a lower vol, the puts on a much higher vol. It's a profitable trade. It's a bit of a carry trade. In that sense, you're able to own a cheap vol, short a high one, be short stock and collect a premium as long as the market goes nowhere. But in order to collect that premium over time, that means as time passes and these out of the money options expire, you have to buy back that stock. And as the probabilities change, not just based on time, but based on implied volatility, you also need to change your stock. If your caller or risk reversal had a 20 delta, a 10 delta put, a 10 delta call, and you were short 20 deltas against it in stock, as time goes forward, maybe it's only a 10 delta. You got to buy back half your stock. And that accelerates, that decay of that delta accelerates as you approach expiration. As implied volatility compresses, it accelerates. And those two things are generally also tied. So you get a kind of a reflexive effect. And as you might imagine, if dealers are constantly buying back stock into these expirations, it's also naturally providing a support, which tends to compress volatility itself, which tends to create the decay of these options actually much quicker because you're getting through the time period when these options are relevant or might actually play a role as a hedge. And that itself, during these periods, can be an important dynamic to understand. But again, the important piece here is that structurally, dealers are both for structured products, for ETFs, for all of these different just speculative kind of hedging are almost, overwhelmingly, I would say, in one direction. And much like the world is long, hedgers are short, and dealers therefore have stock to buy back. That accelerates into expiration. I think, again, it changes in size and scale. It changes based on expiration. It changes in terms of where those puts are generally in terms of the distribution, and what those gamma effects might be as it's tied to that as the market moves. So this is not as simple as just saying, oh, they're going to buy X amount back every day, and so it's easy peasy, sell vol, whatever. But if you can pay attention to the positioning and the dealer's positioning, you can have a significant advantage of understanding the distribution of outcomes and the reflexive effects and flows that come off it, which are very predictive to short-term outcomes.
Excellent. Thank you so much. Now let's talk about supply and demand. And let's go back to that question earlier about the volatility in the S&P being pinned. Now, banks are getting massive amounts and selling the volatility back to the markets. Is that correct? Is that a phenomenon that we're seeing because they're utilizing structured products at this point? Could you tell us about the structured products and what is going on with the supply of volatility, and why is the VIX so low? It's like it's being held down.
Yeah, so few people are talking about this, and I think this is something that we're really trying to bring to the forefront.
Let's take the volatility pill and let's go for it.
So the last time we saw structural inflation 40 years ago, as you mentioned at the top of the show, there were no structured product. There were no, or very limited, right? There were no derivatives. Put options weren't even a thing yet. And so what we're seeing is a very new phenomenon and a very interesting reflexive feedback loop that many people would not have predicted or expected. As the Fed has increased interest rates, you've created this reverse TINA effect, which everybody expected to some extent, right? Liquidity is coming out of the stock market and risk assets, and there's an alternative now to stock. So if I can buy a T-bill for 5.5%, maybe I don't want to be in the stock market at that point, right? Especially given valuations and other risks. There is an alternative now, right? TIA instead of TINA. And the reality is that is something that people broadly expected to be the case as the Fed increased interest rates. The one thing that I think wasn't as expected is the amount of demand there would be for structured products and the increase in structured product issuance that would come as a result of higher interest rates in this environment, and the increased risk that's presented to markets based on valuations during this period as well. Why is there an increased demand with higher interest rates? Well, people may like 5.5% as a alternative to stocks, but generally people would like to supplement that, and with derivatives you can quite easily. there's this thing that I've talked about, which you kind of brought up actually before we hopped on the show today, and something we do with all of our products, which is yield stacking. What most people don't realize is if you own a U.S. Treasury bill or bond, yes, you are getting that interest, but you also have what's considered good collateral in that T-bill. Most entities will allow you to hold that collateral because it's considered essentially risk-free against any risk. Whether that's investment in a house, whether that's options investments. And for the majority of these structured products, they rely on this efficiency of capital to help boost returns. A structured product generally is selling volatility in some form or another to create an exposure to a higher return that's non-correlated. And many of these structured products now can yield 4%, 4.5% now above T-bills. You can get a 10% yield per annum for the next 10 years, for example, by creating a structure in the most basic sense. And there are very different forms of this, whether it's on the call side or put side or a million different knockout options, et cetera. But that essentially give you exposure where you make that 10% within a band, right? And that band, again, can be different each scenario, but you can, in this market, probably yield around 10% by having exposure to the market not decreasing more than 25% or increasing more than 25% in a year and a half time frame. And if, per se, it goes down more than 25%, you would only get put into the market, or if it goes above 25%, you would get short the market at those levels, giving you that nice kind of exposure within a band and also not losing money until you really go to, let's say, 35% either way. This is a pretty compelling investment for a lot of entities, especially people who don't feel comfortable being long the market at these valuations and kind of given where the markets kind of are and the risks that are presented. Very different environment than 2 years ago or 3 years ago when we were experiencing for 12 years straight an up market, right, with an average return of 10 to 12%. And structured products themselves, bonds were yielding 1% or 1.5%, and structured products were probably yielding 5%, right? A 5% structured product in that market environment was not very appealing. So not a surprise that we're seeing a dramatic increase in structured products as interest rates go higher and market risks present themselves. There is unfortunately a reflexive, well, I don't want to say unfortunately, there's a reflexive effect to these positions, because the more structured products that get issued, the more banks as dealers have to take the other side, which means banks are longer and longer implied volatility and long gamma. And the more gamma and implied volatility they take on, the banks don't want that exposure. They want to offset it. So they go to the options markets, and they sell vol in different forms or OTC. They sell vol, and that tends to be tied to where these structured products are tied, which are the S&P 500 primarily in terms of equities, which creates a massive vol pinning at the S&P 500 index level. That can have major reflexive voting machine, reflexive supply and demand effects on the S&P 500 itself. What it's been doing lately is it's been really pinning that market in particular, despite us seeing other areas which are not the central place where this implied volatility supply exists, still moving. And so we've seen dramatic in the last 2 years rotations throughout the market, historic in many ways. Changes in breadth that are dramatic, rotations from growth to value and then back again, right? You saw the technology, NASDAQ liquidation that started in 2021, right? Before the market decline. And now most recently since March, dramatic counter trend move until last month, right? The other way. All of these things are the spinning of the market around the center, which is the S&P 500, where the market is much more pinned and vol is much more supplied. Because of that, we're seeing what's called historic dispersion. The constituents of the indexes are still moving, but the index itself is pinned. And this is becoming a greater and greater hallmark of these markets, where derivatives are much more involved, and structured products in particular are becoming a bigger and bigger component in the market. So ironically, interest rates going higher, even though it's pulling liquidity out of the market, is pinning volatility at the center of the market and actually making it harder for markets to decline, while we continue to get these Vanna and Charm effects under the hood during different cycles. So it can be a very supportive thing that can extend cycles can be very counterintuitive and totally extend cycles longer than you might expect. It's that engine, right, pushing the airplane in a glide path that may be higher and higher off the ground under more and more precarious situations. The question is, how long does that liquidity fire, and under what market environments? And understanding the timing of those can be very predictive in the short term, like I said, even if it's counter to what the fundamentals might be telling you.
Wow, that was so well said. Thank you so much. We went around the whole thing and we went deep and we came back to the surface. This is great. So I want to ask you a simple question on top of that, for just to give us examples for the audience. Structured products. You and I know because we're in the business, but for everyone, what are some simple examples of structured products that they're utilizing right now that are tied to the S&P?
I mean, there's a million, right?
Give us a few.
I always feel like it's almost not relevant to go to each specific one, because the bigger point is the overarching reality, which is all of these are getting you a yield on your money. If you put $1 million in, you're getting that 5.5%, and then they're supplementing that 5.5%, or using that 5.5% in some form or another, right? By selling some implied volatility, some part of the distribution. We talked about the distribution that seems compelling, and that might be broadly overvalued relative to the probabilities of its outcome, and allowing you to get an expression of another part of the distribution, or selling both parts that you believe are unimportant. The important takeaway is that it's selling implied volatility. It might be selling, again, a upside. More times than not, these structured products are selling some type of upside exposure. So a call maybe 2 years out, right? Maybe it's a 2-year structured note that is selling, again, 25% out of the money upside, saying, hey, I don't think we're going above 25%. If we do, I'm willing to take my 10% per year and diminish that exposure by 1% as we go up. But as tends to be the case with these structured products, it's worth having exposure on both sides, right? If you want to hedge, maybe it's long a put versus short that call. Maybe it's premium neutral, but more times than not, a lot of these structured products actually tend to be, something that allows people to get put into the market as well as the market declines to a certain level. Basically saying, look, I don't want to be long the market here, but down 25%, I'd sure like to buy the market anyway. I would do that anyway. I don't want to be long the market here. I'll get paid 10% a year, right? Or 8% or 9% a year to wait. And if it goes down there, I'm happy to be long it. If it continues to go down, I'll take a 1% per decline move in the market from there. But these are essentially options positions. They can have a nice wrapper. They can sound like, wow, that sounds like an amazing deal. Often they involve different parts of the market. It can say, it could be involved NASDAQ calls, Russell puts, different, the S&P 500, maybe, European markets, Japanese markets, et cetera. But broadly, and so they can get incredibly, detailed and complicated. And that's kind of why I don't think it's worth diving into every single variation. But the broader sense here is that you're selling parts of the distribution that are overvalued to help juice your yield, and maybe getting some exposure that you actually want along the way, but doing it in a way where you get a nice little yield along the way, and they're a nice non-correlated, exposure to markets that is an alternative to beta.
Love that. Well said. You have it's like the yield stacking, like we mentioned earlier. And we're going to go into that more after we get through this macro part that I want to talk to you about. We have the inflation hedge. So you have the T-bills, the risk-free rate, that's about 5.5%. And then you stack on top of that, you have derivatives, swaps, all the kind of things that there's so many of them. And then you can get that yield to go to double digits, 9, 10%. It's a beautiful thing. These structured products are amazing. I urge everyone to Google them or to go to your website, because you have these great funds that you have 4 of them on there. And I believe you have a 5th one coming. We'll talk about that as well. But there's great ways of getting real returns, which is key in an environment of higher for longer and inflation embedded. And so definitely something to watch for that. Okay, so I want to go and finish up with the flows. I want to talk about quad witching next month, September. What are you seeing? I know that's a big time for structural products to be expiring and puts. What are you seeing for flows for next month? And can we be in store for some more volatility?
Yeah, so quarterly expirations, as we highlighted earlier, are incredibly important, right? They are the majority of structured products and broad issuance are tied to these quarterly expirations. And they are March, June, September, and December in terms of their tenor. People look at markets, and technical analysts have long highlighted seasonality, right? And I think it's important to understand that seasonality broadly is not a magical construct. There are certain rules and certain flows that we know happen over different parts of the season that are tied to not only these expiration cycles and a lot of these structural effects that happen during different windows, but also as a function of liquidity during different periods and buyback and reinvestment based on beginning of the year, end of the year type effects. All of these things together, when you start to map them together, really do explain the majority of what we see in terms of seasonality. It's not a surprise that the most bearish period of the year is going into September expiration. It's a big quarterly expiration. The second biggest is going into March expiration from February. It's also not surprising that the third is this phenomenon of sell in May and go away, which is the May into June expiration. These periods are periods where there is significant risk in markets, and there are periods where you historically tend to see potential liquidity issues in the market. It doesn't mean that it happens every time, right? It doesn't mean that that these are the only flows that matter, but it does mean that there is a structural risk in markets once that serial month expires, right, before the quarterly expiration. And over that broad expiration cycle, there tends to be some risk. This is the same thing we talked about February to March of 2020. Again, not a surprise, right, that it happened day after Fed expiration, day before March expiration. Everybody says, well, that's ridiculous. It's COVID. Like, how can it be the options market? Well, clearly COVID was a critical piece of it. That's the spark. There was an issue, but we knew about COVID in late December, early January. What did markets do from late December through January till mid-February? They rallied. We knew about COVID. COVID wasn't an unknown reality at that point. But the circumstances of the tinderbox that really is the explosives underneath the market that created the potential risk of that 30% decline were very much a function of positioning in the options markets. And that is historically what is a major driver of the seasonality. So with that backdrop, as we go through August expiration here, important to note that there's significant risk in September, particularly in that SEP OPEX. But as we've mentioned, going into August OPEX, there's still support, much like there was going into Feb OPEX before kind of the COVID crash. But that buyback will really decline to drop off significantly as we approach August OPEX here. And then there's a period, a couple of weeks of real potential risk before you get to the back half of September, right? Expiration, like the back half of the September expiration, which is the first 2 weeks of September, where if something hasn't happened now, you start to see those Vanna and Charm buyback flows again that we've talked about. So if you can start to get some liquidity issues, some volatility increases that reverse some of these Vanna Charm flows, particularly, reverse also some of the buyback that we see at the end of the month from continued moves higher. There's a ton of momentum factors that also play into these. But if you can start to see these flows kind of allow for a beginning of a decline in this post OPEX period, and it accelerates, those are periods of real risk that you need to be very, very cognizant of and very, very careful of. But as I mentioned, you have a kind of short period for it to get going. After that, you have almost the opposite effect. It's not gamma effect, so it's not convex, but these buyback structural effects of the coming SEP OPEX that can really lead to significant daily, day-over-day buyback and support the markets into that. After that, we get into the historically stronger period, right? Particularly after October OPEX, where you really start to see lower liquidity, more holidays, more Vanna Charm buyback. And again, with the market up What it is year to date, a significant amount of front running of the reinvestment of collateral going into the end of the year, beginning of the year, which drives the Santa Claus rally historically in January effects. So there's this important to understand that the factors under seasonality, not just because they're not always consistent, they're not always the same direction, despite what seasonality graphs will tell you. They're a function of other factors that tend to be correlated to seasonality, but they're not specific to the calendar explicitly. And the more you understand those things, the more you understand their probabilities to hedge risk and to be much more cognizant of those flows and that positioning. And you can be more dynamic and really generate real alpha relative to just broad market exposure.
Thank you so much for that. So understanding those flows and how they work and those quarterly time periods being extremely important. And it's not just a coincidence, but they do match up. And that's a fascinating one. The February one with COVID in 2020, it's definitely a fascinating one. So we talk about the short term and how the market is led by these flows. Now let's look at the long term, the macro. Let's talk about that. Let's see how far this airplane is from the ground. So let's see how far we've detached from the reality, the macro reality. We know debt is rising exponentially, 32 trillion here domestically, and rising with this now interest expense of 1 trillion. We got downgraded to now higher interest expense. We have entrenched inflation. And inflation is rising 0.2% month over month. There are data lags. Everyone says, oh, all these companies, their earnings weren't so bad. They're doing buybacks. Well, there's a lag on that as well. There's lags everywhere. And with the real estate market as well, we see housing starts were up, but, and it hasn't crashed. Everything's going to be fine. Well, we know the real estate market is impacted by higher rates. We also know that higher rates aren't good for the market. Why hasn't the market crashed? Well, there's lags. So declining productivity, I call it a dilution of value because we're getting less output for every input. And, it's just a secularly inflationary period seems very likely. We think and we talk in probabilities because we don't know absolutely about anything in the future, but it seems very likely. So, Cem, please tell us your thoughts on all this. And is stagflation still a possible worst case scenario in your opinion?
Yeah, I mean, this could be an hour and a half, 2-hour conversation on its own. So I have to be careful about diving in too deep. Okay. But I'm very much of the view, and I've been very vocal about this for years now. So we were way out in front of this, back when the Fed was inflation was transitory in 2021, 2022. We were very vocal that this was structural. We view what's happening here, and we continue to look for counterfactuals and just see more of the same. Is that we're in a structural period of inflation, as you mentioned. What's driving that structural inflation? At its core, inequality. We've really reached a historic level of inequality. That inequality has been present now for over a decade, but basically 14 years ago, we started to see political effects from it, whether it was Occupy Wall Street or the Tea Party movement. Eventually, the demand and the increasing popular political focus on populism to address this inequality drove new political participants, whether it be Bernie Sanders and AOC on the left or Donald Trump on the right, which are two, whether people think they're opposites or not, they're both incredibly populist and rhetoric, at least, political actors, and they're really driving the left and right, both left. Yes. And as that's happened, that has been a function of the younger generation growing to greater and greater political dominance. Millennials at 40% of the wealth creation and 40% of the household formation of baby boomers at this point in their generation. So they have not been able to participate in the economic growth that we've had over the last 30 years. They are by definition labor. Young people, when they leave high school and college, start out as labor, and as they get older, they accumulate wealth and become capital as a generation. And so baby boomers have primarily benefited in a dramatic fashion from asset inflation. and price deflation, while labor, on the other hand, has not been able to increase their share of wages and income. And this has created a lot of anger among millennials, among the younger generation. They believe that the government doesn't work for them, that the system is broken, and that they believe broadly, and they are becoming more politically dominant as baby boomers die off and millennials grow. They've grown to a position of more protectionism and of more populism broadly. And those effects we've seen throughout history. We saw this in the 60s. As well. These periods when this happens tends to drive big fiscal stimulus. We saw this with the Great Society program in the 60s. That can drive inflation. That is essentially creating a demand push economy where money is going to the bottom of the distribution, where the quote unquote velocity of money is one, but and not to the top of the distribution, where that money essentially doesn't enter the economy but goes to investment primarily. And so that creates inflation, right? And historically, when that happens, inflation, as we know, is a flat tax, and actually ironically hurts the poor the most. And so that populism doesn't get solved by the fiscal stimulus. If anything, that populism gets reinforced by the inflationary impulse and drives more and more fiscal stimulus or redistribution, essentially, of wealth to the lower part of the distribution. If you look up in a textbook what drove the inflation in the 1970s, you'll see as its primary thing fiscal stimulus, but you'll also see two other major effects written up. And people talk about them as they're unconnected to the original effect. Our view is that they're all very connected. Those two other things were the Vietnam War, right, and all the money spent on the Vietnam War. And the other one is economic scarcity, OPEC, the OPEC crisis, and the things that came along with that issue. It's not a surprise that we're seeing the same thing, right? We're seeing OPEC flexing its muscles again, more and more global resource scarcity, and people, countries battling over what resource to bludgeon the other countries with, or use as a bartering tool. It's also not a surprise we're beginning to see a Cold War again. That's when the Cold War started, was the last time. The new Cold War is with China. It's pretty obvious. It's not a surprise we're beginning to see a hot war as well in Russia, Ukraine. These are not just weird coincidences. They're all tied to the realities of protectionism and populism. When you have populism, it is a time of protectionism. People are local. Countries worry about their people. They don't worry about the people of the world. But when they fund money to corporations, they allow corporations to be international. So when we are using monetary policy and supply side economics, what we're doing is we're actually opening up and driving globalization. That's what we did for 40 years. We had a massive expansion in globalization. But when we go to a time of populism, and we're really trying to fix the distribution, we're really worried about the distribution in our country. And that is when you get protectionism. Labor rights drive more protection against labor in other countries, which generally drives countries against each other. And we go from a time of cooperation to a time of competition. And we are really entering a decade of competition. We've been talking about this for years, and it's been playing out almost exactly as we expected. This is what history tells us, and it's not a coincidence we're seeing those same things again. So I told you it's a 2-hour conversation.
I love that you brought
I tried to squeeze it in like the highlights in 7, 8 minutes.
Oh
but the reality is, what this means, we believe, and it's not a straight line to be clear, is a decade of structurally higher inflation, structurally higher interest rates, lower liquidity, higher risk premiums, as you mentioned. And during periods like this, you see really poor risk asset performance. 1968 to 1982, that 14-year period of inflation, equity markets went nowhere in nominal terms, and in real terms lost almost 70% of their value. Almost unimaginable to think, right? Can you imagine a 14-year period where you lost 70% of your money in real terms? It's almost like, to everybody who's been around for the last 40 years, it seems impossible. The greatest irony of that is actually economic growth. GDP growth was above trend, was actually hotter in real terms, not just nominal. Nominal, it was way higher, but in real terms was higher than it has been for the last 40 years. So talk about fundamentals not being a predictor of market performance. I mean, could you draw a better analogy than, hey, in the last 40 years, economic growth has actually been way worse than it was 68 to 82. We've seen dramatic real returns in markets during that time. But during that period, we saw negative 70% returns with stronger economic growth for 14 years. Why? The market's a voting machine. At the end of the day, there are less buyers than sellers in inflationary periods because there's just broadly less money. There's less liquidity. Those engines aren't firing. So there's less demand for risk assets. A. B. There is an alternative. If bonds go from 3 to 5 to 7 to 9 to 11 to 13 to 15 to 17, guess what? At some point, people aren't going to buy stocks. People are just going to buy bonds. And so the higher interest rates go, the less liquidity there is. B, there's more alternatives to equity performance. Lastly, you mentioned this risk premium goes up. There's just less liquidity in the market. The dealers and people absorbing the market structure, they have less money. Bid-ask spreads widen out. Risk assets are more dangerous, right? So people move away from the risk curve, and risk premium accelerates during these periods. So significant headwinds. That expressed itself 68 to 82 in significantly lower price to earnings. We started at the beginning of that cycle somewhere around 25 PE. It was at 4.5 when it bottomed in 82. That's 20% of the valuation, right, in earnings term. But that's just the beginning. Price to sales, which is really what's tied to GDP, and GDP growth dramatically changes even more because you get margin compression. Why? Labor becomes a greater amount. This is the distribution at work. The labor is capturing a greater share of the profits. That's more expensive to companies. Never mind the deglobalization and the conflicts and all the other things that we've talked about that drive lower and lower margins. So between margin compression and earnings multiple contraction, you can find yourself, despite dramatic earnings growth, despite particularly GDP growth, in a significantly lower market valuation.
Love that. Well said. I love how you touched upon the geopolitical issues, politics. I know you had a triple major, which I find very impressive, and you had policy study. You had, that was one of your majors, and your historical recollection is amazing. And you mentioned demographics, the changing, the baby boomers, the millennials. Excellent, excellent examples. I love how you brought and tied everything in together, because ultimately it's about everything. It's not just about the money supply increasing, which I am a monetarist at heart, and I do believe increasing the money supply as much as they did, does decrease the value. When you increase the supply, the value goes down. And so that's an important part of it. But all these other issues, the politics involved, and I was actually, when you said it, I actually was thinking about it, protectionism. Absolutely. I believe we're going on with that. I had a great guest, an international relations scholar on here, Dr. Randall Schweller. Amazing. He's written so many books. He talked about that exactly, and how we are multiplayers in this interconnected world, and everyone's looking internally now, worrying about themselves. So at the same time, you put that together with this secularly inflationary period, it all makes sense. It all makes sense to me. Thank you so much for that. I know we're on a time crunch here, but I want to go into the yield stacking and these opportunities. There's plenty of opportunities out there, and that's so important to talk about. So there's an importance of real returns because of this inflation. And so it's so important to go into that. So let's talk about this yield stacking and your ideas of how you can diversify with all these other strategies, with derivatives, swaps, and you can capitalize on these sort of, I guess, I love the word you use, structural mispricing. And I think that's a great way of saying it. So tell us about that and how you can capitalize on that to create these yields that are, double digits, which are above inflation, which is a real return.
Yeah. So tying back everything here, and I'll be real kind of pointed and quick with this, there is an efficiency of capital that you're able to take advantage of with derivatives. You can not only get the risk-free bond yield underneath the hood, but you can actually now add to that. You can stack above that with other real, compelling investments. And the more edge you have that's non-correlated, the more you can stack that above this collateral, this T-bill that you have. It allows for real, superior risk-adjusted returns in the sense that you can kind of have your cake and eat it too. You can have that T-bill and still use the collateral for compelling non-correlated returns. We have 4 funds. One is a vol neutral fund that does, all of them do this yield stacking piece. But the vol neutral simply goes and looks at the relative value opportunities in the volatility distribution and says, okay, where on a risk-adjusted basis are the best relative value? Vol neutral, we're not trying to take a delta exposure. We're not trying to take a vol exposure explicitly. We're really looking at relative value, where the relative value opportunities lie. And you can, by doing that, if you have kind of a deep market expertise, find ways with very low risk to really extract a yield that kind of sits above this amount. We've done this for quite some time successfully, and it allows for, again, compelling, low risk, high return, non-correlated liquid strategies. And that's a very kind of obviously compelling thing to have in your portfolio, particularly if we're entering a period like 68 to 82, which we believe we are, where market returns are going to be quite weak over that period. So if you can compound, and particularly in a way where you're doing it on a yield basis, where that yield is a short duration, you're able to continue to follow to higher and higher underlying T-bill yields and have an inflationary hedge. Not to mention these products are tax advantage if you're doing them at the index level. There's a lot of very compelling pieces to doing this. So that's our vol neutral product. We do something similar with the dealer flow. Instead of just looking at relative value, we're looking at more predictively that dealer positioning we talked about, looking at when in certain windows there's a higher probability of certain outcomes, and really positioning long or short, or long vol or short vol, very actively underneath the hood in these windows to take advantage and extract, again, a non-correlated yield with lower risk relative to our returns, a very, again, yield stacked opportunity. And then lastly, we have our long vol. So if you're really looking for a strategy that's not just absolute return, but a way to maybe hedge, maybe you want to keep your long exposure, but you want to offset it and really get an embedded hedge that has a positive return historically. So since we've ran it, we've had a positive expectancy in it, which is quite some time. So that's a very hard thing to do with insurance. If you're able if you're looking to do that, to get a hedge, that's a very compelling product. Again, it's yield stacked, so you're getting that T-bill return underneath the hood and then getting a hedge stacked on top of it. And then lastly, our fourth, we have a multi-strategy, which really we believe is the best approach, right? Is let's use a diversified approach to this exposure and not only stack that yield, but do it in a way where you're getting non-correlated returns across them. And that, not surprising, is our highest Sharp product, because it's a diversified offering of different structured edges that sits on top of that yield. And again, these products are liquid. They are, meaning monthly liquidity. They are tax advantaged, and as I mentioned, non-correlated, which is critical, we believe, in this type of environment. So these are things that you can do. Obviously, it takes some deep expertise to do some of these. If you're looking for a a lower fee but less higher return amount of alpha, there are structured products like we mentioned that do these things, just at a much kind of with more risk and less kind of relative value returns. But these are all compelling ideas, and we believe this is a decade to 15-year period at a minimum where these types of products are going to be dramatic outperformers to equity exposure, and in a world where it's going to be very hard to get the kind of returns that people are used to, are going to not only be able to provide some of those returns in a very volatile, difficult period, but do it with inflation protection and continuing improvement in those returns over time. So that's our approach. Again, we believe it fits into not only our macro view, but our deep expertise of understanding these flows and focusing on them as the primary driver for returns.
Thank you so much. Well, you're definitely the expertise on all of this stuff. So, and I love all four of those. I love that multi-strat, especially because it varies between the other three. And I saw that there's a bell curve for the dealer flow, and the long volatility has that upward parabola. Very, very cool stuff. And I believe you have another one planned for the future. Is there?
We have one that we're working on.
Macro
I'll tease it real
vol?
quick, but we're doing a macro vol fund where we're going to really
Exciting.
take a bit of a departure away from the equity exposure into, given this decade, which we believe will be continued kind of volatility across market structure, given all of the global conflict, both economic and otherwise. We believe there's an incredible opportunity there, particularly across the distribution with asymmetric bets, which is what we're good at.
That's exciting. I love diversification across asset classes. You have commodities, fixed income, currencies, global. Exciting to see your next product that comes out for sure. I want to know, how can investors take advantage of these strategies with Kai at Volatility Advisors?
Yeah, no, thank you for bringing that up. You can go to our website, kaivolatility.com. You can request a meeting there, inquire about products. We also put out kind of weekly pieces, podcasts, other written things, and you can get that and subscribe to that at kaivolatility.com/news. But yeah, you can also find me on Twitter at jam_croissant, JAM_croissant, and where we're pretty active and always give kind of timely insights.
Awesome. Thank you so much, Jem. These are very important discussions to have because we are in different times. Even Druckenmiller said this is going to be a lost decade, but you know what? It doesn't have to be. A lot of great opportunities, and I love your products. Very exciting. Thank you so much, Jem. And thank you to all the listeners.
Thanks for having me. Take care.
Take care.